Hi, we are continuing example sums on the topic of guarantee of minimum profits to partner. In this video, we will cover the case where the firm incurs a loss during the accounting period. Let's go to the example. Example: A, B and C are partners having capitals of rupees 10 lakh, rupees 8 lakh and rupees 6 lakh respectively in a firm and sharing profits and losses equally. C is guaranteed a minimum profit of rupees 1 lakh as a share of profit every year. The firm incurred a loss of rupees 3 lakh for the year ended 31st March 2019. You are required to pass the necessary journal entries and also open the necessary accounts for the division of the loss and giving effect to minimum guaranteed profit to C. So from this problem we understand that though C is guaranteed a minimum profit of rupees 1 lakh every year, in this particular year the firm has incurred a loss of rupees 3 lakh. So let's see how we'll go about the journal entries. Solution: journal entries in the books of the firm. Date, particulars, LF number, debit rupees and credit rupees. The date is 31st March 2019. The first journal entry, we need to distribute the loss of rupees 3 lakh from the profit and loss account to A, B and C in their profit sharing ratio, which is 1:1:1. So let's do that. A capital account debit, B capital account debit, C capital account debit to profit and loss account. The total losses rupees 3 lakh on dividing by 1:1:1, each gets share of loss of rupees 1 lakh. Narration: being losses transferred to partners' capital accounts. Next journal entry: we'll need to pass the journal entry for the deficiency to be borne. First, let's calculate the amount of deficiency. Amount of deficiency when C gets a share of loss is the guaranteed profit of rupees 1 lakh plus his share of loss, another rupees 1 lakh. Therefore, the deficiency is equal to rupees 2 lakh. There is nothing mentioned in the sum as to who will bear the deficiency. So, firm bears it. In other words, A and B will bear the deficiency in the old profit sharing ratio in between them, which is 1:1. So let's pass the journal entry for giving 2 lakh to C and A and B bearing the deficiency. So it's A capital account, debit, B capital account debit, to C capital account. Rupees 2 lakh given to C to be borne by A and B in 1:1 ratio. So A bears 1 lakh rupees and B bears 1 lakh rupees, being deficiency borne by A and B in 1:1 ratio. So this is the answer to journal entries. 2 journal entries. The first one for distribution of loss to partners' capital accounts in their profit sharing ratio, and the second one for deficiency being borne by the guaranteeing partners. Next, let's go to the ledger accounts. Solution. Same sum. Preparation of ledger accounts. Profit and loss account for the year ended 31st March 2019. Left side debit and right side credit. Particulars: rupees, particulars, rupees. We'll bring down the losses of rupees 3 lakh to losses brought down rupees 3 lakh. Next, we'll divide the loss among the partners in their profit sharing ratio by loss transferred to partners' capital accounts. A, B and C. Each partner's share of loss is rupees 1 lakh. Total loss transferred rupees 3 lakh, and the total of the profit and loss account is also rupees 3 lakh. So this is the ledger account that needs to be prepared first. The profit and loss account. Bring down the losses and transfer the losses to the partners' capital account in their profit sharing ratio. The next account that needs to be prepared is the partner's capital account. Partner's capital account. Left side debit, right side credit. Date, particulars, A, B, C, and again date, particulars, A, B and C. Let's bring down the balance on 1st April 2018. By balance brought down. The balance of capital accounts of the partners, rupees 10 lakh, rupees 8 lakh and rupees 6 lakh. Next is to debit the partners' capital accounts with their share of loss. 31st March 2019 to profit and loss account. A share of loss 1 lakh, B share of loss rupees 1 lakh and C share of loss is also rupees 1 lakh. Next, we need to post the entry for A and B bearing the deficiency of 1 lakh each. So 31st March 2019 by A capital account under C rupees 1 lakh and on the same date by B capital account again on the same date rupees 1 lakh. On the debit side on 31st March 2019 to C's capital account under A rupees 1 lakh and under B also rupees 1 lakh. Let's balance the account. The total rupees 10 lakh for A, 8 lakh for B and 8 lakh credit total for C. Writing the totals on the debit side. On balancing, we get the balancing figure 2 balance carried down 8 lakh, 6 lakh and 7 lakh. I'll bring down the balances at the beginning of the next year. 1st April 2019 by balance brought down rupees 8 lakh for A, rupees 6 lakh for B and rupees 7 lakh for C. So this is the next ledger account that needs to be prepared. So in all the sums where the firm incurs a loss, we need to prepare journal entries if required as what has been done just now, and 2 ledger accounts, the first one being the profit and loss account and the second one being the partner's capital accounts, assuming the fluctuating capital method.